Today, folks, welcome to the very center of a catalyst tornado. I mean, the news that is going on is just mind-boggling. We have an election cycle in the US. We've seen rotational events out of tech into the lower half of the market. Today, the market is just desperately trying to hold on. We've got inflation data. We're going to be talking about interest rate cuts, but more particularly zooming in to the Canadian economy. I have investments in Canada. I have high hopes, even though there's a lot of concerns as we take a look at the banks. We'll talk about real estate and REITs. We'll talk about some of the telecom giants, but to kind of roll back the perspective here, and the reason I'm discussing it is because we've seen inflation over the entire year pull in at 2%, uncomparable to the US that's been, hovering a lot higher, leading to a delay in interest rate cuts. Canada's already started cutting rates, and there's high expectations that the Bank of Canada's meeting next week will lead to another interest rate cut. However, though we thought this would be a huge catalyst to move the market, it really didn't do a whole lot on the first interest rate cut cycle. In fact, stocks continue to go down. Yet in this new rotation happening in the US from big tech to the lower half of the market, Canada seems to be getting some of that money. I don't think the news of interest rates cutting again would be enough to drive this much volume into the broader Canadian markets. VCE is the VOO of Canada. It just represents like the S&P 500's version, right? Like Canada's top companies in a passively weighted index. And just over the last 5 days here, this thing's up 1% the last month, almost 5% year to date, giving some pretty nice gains. We're not talking about the insane double-digit growth of the S&P, but for Canada with the dividend yield at 3% on this index, this is a really awesome return. Now, I'm primarily fixed into VDY, which is also benefiting pretty greatly this week. And I want to talk about generally what interest rate cuts are probably going to do for the broader TSX, because we haven't felt it bake into the market yet, but in the coming quarters, and I told you it's going to take about 1 to 2, maybe even 3 years for this to bake in as interest rates slowly start to decline. And especially as they decline in the US, this will probably boost even the Canadian economy that much more, because typically the Canadian markets will really just move on what the US markets are doing. But let's talk about Toronto Dominion Bank here first and foremost, right? Because this bank has been under so much tyranny when it comes to, the unfortunate money laundering events that happen when they were talking about, fentanyl, probably big drug gang crime out of China. Who knows, right? They're probably going to face some fines. There's been just a lot of negative news with this company over and over. They lost the deal for First Horizon in the States when, regional banks started to have some collapse. I mean, it's been a never-ending bad news cycle, but now that news cycle might be starting to shift. I mean, we wiped out almost 5 years of gains here. The stock at peak to trough dropped over 30%. And now we're starting to rally back, man. In the last 5 days, we're up 4%. Is this the bottom? I don't really know, but I'm starting to feel a little bit more hopeful. This 5.1% yield that you can lock in today, if you are an individual stock investor, if you like the banks like Pokemon cards, I always suggest just collecting them all. You have to recognize that we are living in peculiar times. The last time we've seen dividend yields this high was during the pandemic, but you can go back through TD's entire history and you would have never seen a yield like we see today. So is this an opportunity of a lifetime? I personally believe it is, and I take advantage of it through VDY because it's a 10% weighting in VDY. So for every $1,000 I put in here, 100 is going directly to TD. It's an easy way to get exposure while also getting exposure to the other banks. But man, this peculiar time, I'm telling you, isn't going to last forever, and it's likely going to pass. And when you just take a look at the financials, they're incredibly robust. I mean, we're talking about a company that continues to grow revenues. I mean, if you go back to April of 2023, from $12.3 billion to $13.8 billion, even quarter over quarter, we're seeing some pretty nice revenue growth. The big fear right now is that the vast majority of mortgages are going to come into renewal in the next basically in the next 2 years. The next 1 to 2 years are critical for the Canadian economy to survive, especially for the banks to start proving some resilience here, because they've been losing so much net income to loan loss provisions, which are just provisions in case we see a huge spike and defaults in mortgages. And that is a risk. It is a real risk. However, we live in a pretty strong economy. Same with the US. There's always talk about the increase in debt. People are struggling with inflation, but we're not collapsing right now like China's real estate market is. We're not seeing a lot of the issues the global markets are. So I believe Canada will survive this. 1 in 3 Canadians own their homes. I think we're in a slow period for real estate. Heck, even in the US, when you look at a state-by-state basis, I think Florida's seeing a bit of a correction right now in real estate. Like I said, this is going to be a slow, long-drawn process. But again, if we can survive this, these banks are such a huge buying opportunity. I mean, look at how well the banks are doing in the US. They have the same fears. They have the same issues of a very expensive real estate market across pretty much the broader states. Yet, JP Morgan's been able to thrive in this market. Look at the 5-year return, almost 100%. Year to date, 22%. The 1 year, 36. It's just unbelievable how fast JP Morgan pulled itself out of the lows of 2022, right? So if we shift a little bit and we kind of zoom in on the real estate market when it comes to the real estate investment trust, there's been a lot of high hopes that there's going to be a recovery here. I mean, we hit lows that we haven't seen in a while, and just within less than a month, this thing spiked up 10%, actually giving a gain for the year. I mean, from the 5-year, we're down dramatically, right? I mean, 20% from those lows into this year, 27%. I really have some interest in these ETFs because they do give you a good scope on what's happening with the real estate sectors. And we're starting to see a spike with a lot of these companies, even in the States with O Realty Income. I like Canadian Apartment Properties. It's one that I have been following that spiked up as of recently, also paying a rather historically high yield for its history at over 3%. And there's been some big news with these companies because they're still trying to manage the debt, which I find this is an interesting time to be doing so because, again, we're heading into an interest rate cut cycle. But when you take a look, they recently announced that Canada's largest apartment REIT is selling their mobile home business to TPG, and they're going to pay them $740 million. I actually went on to prove this news out of their investor relation page on Canadian Apartment Properties, and this is true. We are absolutely seeing a massive, almost $1 billion, $750 million coming into their cash, which is quite incredible, right? And basically, they're just saying they're going to use this to pay down the revolving debt. They're going to clean up their balance sheet, and any extra cash they have, they're going to utilize for further purchases down the road. I find this interesting because they do have a pretty strong balance sheet as it is. I mean, if you take a look, they have if you take a look at their balance sheet, even on just Yahoo here, they've got about $17 billion in assets and only $7.6 billion in liabilities, right? I mean, they have less than a 50-50 ratio to debt to assets, and it looks like they're going to be paying down a huge chunk of this. I mean, they're definitely putting themselves in a much stronger position for the future. So it'll be neat to see how they kind of come out of this. It's one of my favorite REITs to watch, so I'll be paying attention to their quarterly earnings that will be coming up within the next month or two. Most of the Canadian markets do not post earnings till about August, so we will be waiting for the banks, many of the Canadian stocks well after the U.S. earnings. But I'm also paying attention to companies like TELUS that popped off recently. A lot of people concerned here is this thing's been tanking. I mean, year to date, it's down 8%. With the recent rally of 6% off those bottoms, also paying an absolutely absurd 7% yield. These are more utility-oriented stocks. I mean, TELUS is a huge infrastructure play in Canada, and it's one of my favorites. And I just can't get over that it's, tanked 35%, wiping out, almost a decade's worth of gains, which is just bonkers to me because they still have incredible revenue growth, right? They've been holding absolutely strong from a revenue standpoint. What's been really killing them is their obvious net income, as they've been doing a lot of expenditures that they've been using as write-downs. They haven't been putting a lot of free cash flow on the books. Even though they have the cash to pay the dividend, it doesn't get equated to net income. So the stock has been primarily following this net income chart, which I think at some point will turn around as the interest rate cut cycle continues to alleviate that pressure from their balance sheet. We don't have a whole lot of news. If you go into TELUS's media here, I mean, they've been expanding dramatically. They've been posting news nonstop about expansions with pure fiber services. They never stop. We talked about this on a recent video. They invest $8.5 million in the Lower St. Lawrence, $6 million into the peninsula of Gaspé here or whatever, $6.6 million in the North Shore region, $10 million in New Westminster. Like, this company has a lot of capital. They're investing it. They're continuing to build the infrastructure. These companies don't go anywhere, similar to Bell. I just don't like Bell because it has legacy media attached to it, which I think is going to continue to hinder in the future. We'll see how Crave performs for them, but like I said, these are interesting stocks to look at. I always recommend just buying the broader ETFs, however, to get the exposure to these companies, because in the meantime, while we wait for the performance of these companies to catch up, you can get the benefit of financials, right? Like, I mean, the reason VCE is up so much is because there's been so much performance in financials when it comes to insurance specifically, like MFC, for example. I mean, Manulife Corp is up 24% year to date. They benefit so greatly from the high interest rate environment, but there'll be, again, a rotational shift as interest rates come down. They won't be able to bank as much on their cash and high interest savings or wherever they're storing that cash, and money market funds perhaps. But like I said, we have a lot of tailwinds at play here. We're going to see money market funds start to dwindle as interest rates cut, and then we're going to see that money float around, and it's going to be neat to see whether that ends up in tech, what tech earnings look like, what the presidential elections do to the market. It's just going to be a very entertaining market for the next quarter, 2 quarters. But I'd love to know what you think in that comment section below.